Imagine a world superpower at the height of its influence, brought to its knees not by military defeat, but by a speculative frenzy, a financial illusion so grand it ensnared kings, commoners, and politicians alike. This isn't fiction. It's the true story of the South Sea Bubble, a calamitous event from the early 18th century that serves as a stark reminder of the fragile line between innovation and utter disaster. It was a bubble that didn't just burst. It shattered fortunes and, for a terrifying moment, threatened to crash an empire, Great Britain, then a burgeoning global power. At the heart of this storm was the South Sea Company, established in Great Britain in 1711. On the surface, it seemed like a brilliant venture designed to bolster the national interest. Britain, emerging from costly wars, was saddled with a massive national debt, a heavy burden for the government. The South Sea Company proposed a seemingly ingenious solution. It would absorb a significant portion of this government debt in exchange for exclusive trading rights with the Spanish colonies in South America, a region then believed to be overflowing with untapped riches. The allure was irresistible, a patriotic duty combined with the promise of unimaginable profits from a lucrative, if theoretical, trade monopoly. This deal promised to both reduce the national debt and provide new avenues for imperial wealth. The story really kicks into high gear around 1720. The company presented a grand scheme to Parliament. It would take on the entirety of the national debt, an astronomical sum for the time, amounting to over £30 million. In return, the government would pay the company interest on this debt, and existing debt holders would exchange their high-interest government annuities for shares in the South Sea Company. This was essentially a debt-for-equity swap on a national scale, transforming long-term government bonds into shares of a supposedly dynamic trading enterprise. The public, weary of war debts and eager for a share of promised prosperity, clamored for these shares. The company, through shrewd marketing and outright deception, painted a picture of boundless opportunity. They hinted at vast, untapped resources in South America, even though actual trading opportunities were minimal due to ongoing hostilities with Spain and the complexities of international politics. As the government accepted the company's proposal, a wave of euphoria swept across Britain. South Sea stock, initially offered at £128 per share in January 1720, began a dizzying ascent. By April, it had reached £300. By May, £550. And by July, it peaked at an astonishing £1,050 a share. This wasn't driven by actual trading profits, which remained negligible, but by pure speculation. Everyone, from humble servants to the highest nobility, wanted a piece of the action. People mortgaged their homes, borrowed heavily, and threw their life savings into South Sea stock, convinced it would only go higher. This rampant speculation also spawned countless other bubble companies, many with absurd or ill-defined purposes, all fueled by the same irrational exuberance. Parliament, alarmed by these smaller, more obviously fraudulent ventures, passed the Bubble Act in June 1720, aiming to curb their activities. Ironically, this act, by focusing scrutiny on speculative companies, also inadvertently started to chip away at the confidence in the South Sea Company itself. The signs of trouble were subtle at first. Some shrewd investors, seeing the disconnect between the company's actual performance and its skyrocketing share price, began quietly selling off their holdings. As the stock became harder to support at its dizzying heights, fear slowly began to replace greed. The market, like a tightly wound spring, couldn't sustain the pressure. By early September, The share price had plummeted from its peak of £1,050 to under £200. Panic ensued. Fortunes evaporated overnight. Thousands were ruined, their life savings gone, their land mortgaged for worthless paper. The crash sent shockwaves through the entire British economy, leading to widespread bankruptcies, social unrest, and a profound crisis of confidence in the government and financial system that had allowed such a spectacle to unfold. So why did this happen? The South Sea Bubble is a textbook case of human psychology clashing with market dynamics, offering timeless lessons in economic behavior. At its core, it demonstrates irrational exuberance, a term coined much later, where asset prices become entirely detached from their intrinsic value. People weren't investing in a solid business with predictable earnings. They were speculating on future price increases, driven by the fear of missing out and the allure of quick riches. This herd mentality, where individuals follow the actions of a larger group regardless of their own individual assessment, amplified the bubble. As prices rose, more people jumped in, creating a self-fulfilling prophecy of sorts, until the pool of new money ran dry. Furthermore, a severe lack of transparency and effective regulation allowed the South Sea Company to engage in misleading practices, withholding crucial information and wildly exaggerating prospects, effectively pumping the stock without underlying value. The credit extended by the company itself to encourage share purchases also played a significant role, leveraging up the market and making the eventual fall even more painful when those loans couldn't be repaid. It was a perfect storm of human greed, widespread misinformation, and an unregulated financial environment. The lessons from the South Sea Bubble resonate across centuries, offering crucial insights for investors today. First, never confuse price action with fundamental value. A stock going up rapidly doesn't necessarily mean the company is doing well. It might just mean more people are betting it will keep going up. Always understand what you're investing in and its underlying business. Second, beware of herd mentality. When everyone around you is excitedly rushing into an investment, it's often a sign to pause and do your own independent research, rather than just following the crowd. Remember the maxim, when the taxi driver gives you stock tips, it's time to sell. Third, avoid excessive leverage. Borrowing heavily to invest magnifies both potential gains and, more dangerously, potential losses. Many South Sea investors were wiped out not just by the fall in share price, but by the crushing debt they incurred to buy those shares. Fourth, diversification is key. Don't put all your eggs in one basket, especially a speculative one. Finally, regulation matters. While not always perfect, robust regulatory frameworks are designed to protect investors from fraud and manipulation, something sorely missing in the early 18th century. The common mistakes then are sadly the common mistakes now: chasing unrealistic returns, failing to do due diligence, and letting emotion override reason. The aftermath of the South Sea Bubble was devastating. It led to profound political upheaval, parliamentary investigations, and the impeachment of several high-ranking officials. The public trust in financial markets and government was severely shaken, forcing a major reckoning within the heart of the burgeoning British Empire. Yet, from the ashes of this disaster, important lessons emerged. It highlighted the critical need for financial regulation, transparency, and a healthy skepticism towards promises of instant, boundless wealth. The South Sea Bubble stands as an enduring parable in economic history, a vivid, dramatic reminder that while markets can soar on hope and innovation, they can just as quickly collapse under the weight of human folly and unchecked speculation. It teaches us that understanding history isn't just about looking backward. It's about gaining wisdom to navigate the complexities of our financial present and future, ensuring that the empires of tomorrow are built on substance, not just on the fleeting air of a deceptive bubble.